Welcome to this Killik Explains Finance video. This week, 2016's puzzle, at least it was a puzzle up to the point this video was shot in July, rising share prices. Why are they still rising? Can they keep on rising? Well, I don't know the answer to the second one, but we can certainly take a look at the first. Now, old versus new. This is more like an old-fashioned headline, if you like. Global shares rise, bond prices fall on investor optimism. The old Fed model holds that those two assets traditionally tend to go in opposite directions. But that's not what we're seeing recently. More like something the FT wrote, need for yield, whatever that is, explained in a moment, sends bond and equity prices in lockstep to record. Now, that's a bit weird. Equities and bonds rising together. It's been happening for some time. Let's take a look at it. Now, the Fed model, the old model, if you like, the textbook model, says, in theory, when investors feel confident, they buy equities and sell bonds, all right? And equity prices therefore rise and bond prices fall, or if you prefer this language, bond yields rise while equity yields fall. And the opposite's true. When investors feel nervous, they tend to buy bonds as a safe haven, accepting the lower income in return for safety, and dump equities, which sends bond prices up and share prices down. And that's part of the reason why those two assets are seen as natural diversifiers, because they are a bit yin and yang. So bonds, for example, low default risk, lower predictable returns in terms of coupons and so on, a steady income and relatively low volatility makes them quite a useful safe haven asset. Equities, on the other hand, higher, not high, but higher default risk, higher, less certain returns, variable income, dividends can get chopped, changed and cut and so on, and higher short-term but manageable volatility. Now, recently, what have we been seeing? Well, it's not a lockstep pattern, but you get the idea. You can sort of see the two kind of going up together, up to the point this video was shot anyway. So if we took the UK 2% 2025 gilt as a benchmark, that's the line in blue, and compared it to the FTSE 100, the line in red, we certainly don't have the Fed model obviously in play. I mean, we do in a few places like there and there, but the overall trend in both cases is kind of upwards, albeit a wobbly line upwards. Now, just to recap, what's happening to bond prices? Why do government bond prices, for example, keep on rising? And this is something that I've dealt with in other videos in more detail. It's a combination of very low inflation, even deflation expectations, record low interest rates, their safe haven status. People always want a safe haven in times of Brexit, Russian, geopolitical turmoil and so on, and government buying, government stimulus measures at record levels, taking supply out of the market. Question is, what's been pushing share prices up too? And I'm going to suggest 4 or 5 ingredients. None of these is probably the full explanation by itself, but combine them and maybe we're getting somewhere. Number 1, yield hunger. Investors need an income stream, and let's face it, cash and bonds are really not offering it. I mean, yields have gone negative in some cases. So maybe, as the economists put it, stocks, if you're a yield seeker, are now the least dirty shirt on the washing line. They do provide yield, or at least some of them do, in the right hands. Low discount rates could be a factor too. This is a technical factor. This is just the fact that if you've got low interest rates and they stay low, people suddenly start to say, well, actually, the value of the future income generated by a company in the form of dividends starts to rise. It becomes per se more valuable. Now, a very simple example, if a company was only ever going to pay one dividend in its life, £100 in 5 years' time, and interest rates are 10%, and you were thinking, let's discount that back to what it's worth today, you'd have around £62. If interest rates are more like 5%, they're not, but if they were, that same coupon is worth more like £78 now, so its value's gone up a bit. And if rates are only 1%, then it's worth 95. So here's the point. Low interest rates, if they're expected to stay low, push up the value of future income. And maybe that is one of the factors in terms of pushing up or sustaining share price rises. Number 3, the central bank put. People have got used to the idea that central banks will bail them out of trouble. Brexit, maybe the Bank of England will reduce rates. US growth slows, Fed reduces rates. Something goes wrong in China, Central Bank of China steps in. Something goes wrong in Japan, Central Bank of Japan steps in. You get the idea. People have become used to something called the Greenspan put, named after the ex-chairman of the Federal Reserve. You can't fight the Fed and therefore go with them. They'll always step in. Now, how long that can continue for, that kind of conjuring trick, if you like, as some people see it, who knows? But it's worked to date. Then we've had 2 relief rallies. The market kind of going, phew, things were not quite as bad as we thought. And maybe people who are betting against shares, betting on prices falling, have got a bit fed up this year of constantly losing money. So we've had China, people thinking, oh, China's slowing. Oh, actually, maybe not as fast as we thought. Then we've had Brexit. Oh no, what if the UK votes to leave the EU? Well, that exactly is what happened, but the world hasn't ended. So we've had a couple of perhaps relief-based rallies and people betting on falling prices getting out of the market. Maybe that's contributed to the rally we've seen. And then there's the US effect. When the US sneezes, the world catches a cold. And people keep expecting the US to sneeze on low oil prices, for example, but it hasn't. So in June, we had 3 pieces of data that were reasonably positive. Non-farm payrolls, manufacturing PMIs, and consumer spending. Now these could turn around, but essentially the US doesn't seem to have a cold at the moment, in spite of some of the expectations around Christmas. Now it could all go wrong. Every silver lining has a cloud. So 5 things to keep an eye on, if you like. Stocks are relatively expensive. Depends how you look at this. Some people will disagree. But taking Warren Buffett's old favourite, market cap to GDP for the US, for example, or price to forward earnings, yes, there is a case for saying stocks look a bit toppy. Number 2, uncertainty over China may have gone away a little bit this year, but it could come roaring back again, so watch that space. The overall impact of low oil isn't 100% clear yet. It's still relatively early days in the kind of low oil world. Brexit's only just happened, so let's watch that one, particularly for the UK and Europe. And the higher prices go, be warned, this is a rule of thumb, the greater the potential for a black swan shock. So if they do fall, they could fall quite a long way. Leave you with those thoughts. Any questions, editor@killik.com. And to watch other videos on shares, please click the shares tab at killikexplains.com.